In this video, I'm going to run through 9 trading edges. We're going to look at each individual one and how each one can improve our chances of trading success. Stay tuned. Okay, so following on from the video where we talk about, we know that we want to increase our trading edge, right? That's a given. If we can improve and increase our trading edge, i.e. increase the probability of success for each trade, over time, we will make more money. Okay, and we talk about the casino model and obviously with the roulette wheel. And imagine if the roulette wheel had, 5 zeros in it, then they would make so much more money over time because their edge is so much bigger. Obviously, people wouldn't play the game, but you get the point. So what we're trying to do as a trader is increase that trading edge. Okay, so I've got kind of 9 broad things that I will class as potentially a trading edge. And these are kind of things that, as traders, we do to try and improve our chances of success, over 50-50. So if we're not just tossing a coin, we're trying to do these things that will give us a little bit more chance of success. So the first one is a pretty obvious one. It's chart patterns. So, as traders, we look at chart patterns, we look at things like head and shoulders, double tops, double bottoms, all those kind of things. And we look to see if potentially we can see that chart pattern and make a decision on that. Now, the theory behind this, of course, is that history has generally said to us that this chart pattern is profitable. So when we see a head and shoulders at the top of a trend, and we take a break of the neckline, classic 101 charting kind of stuff, then we're expecting it to push lower. So the theory is that we take that trade. Now, obviously, this is a whole new topic in itself, and I'm not going to go down the rabbit hole of talking about the pros and cons of chart patterns, but I'm kind of saying, listen, the right chart pattern in the right environment has a good chance of success. It's got a better chance than 50-50. There are times when, some chart patterns are dubious, but let's not go into that. Let's just say that, okay, agreed, that number one is chart patterns. If we look at chart patterns, we're doing technical analysis, we can give ourselves a little bit better chance of success than if we were just picking buy or sell. Number 2, support and resistance. And what I mean by this is a classical buy, support, sell and resistance trade. Not necessarily a breakout trade, but the theory being that, okay, if we class support as anywhere that the market has pushed once or twice, however we define it, doesn't really matter. But we know that if we buy at a support level or we sell at a resistance level, that's probably a better place to make a trade than either before the level or after the level. Okay, we've got some little flexibility there. I know we can go a bit more advanced and have breakouts, fake outs and that kind of stuff. But if we can keep it basic for now and say, hey, listen, if we're buying at support, if we carried on buying at support every single trade we did as opposed to not buying at support, would we have a greater than 50-50 chance of success? We probably would. This is why traders look at support and resistance while they draw them on their charts. They draw trend lines. Acting as support, they drew static lines. We have key levels, whole numbers, this kind of thing, levels of congestion before. Any way we define it, support and resistance, prior highs, prior lows if we're day trading, overnight highs, overnight lows if we're day trading, that kind of thing. Okay, number 3, trading with the trend and the supply-demand imbalance. I added that because I like to talk about supply-demand imbalance. That's really why my mind works with trading, thinking of it purely as that kind of flow of supply and demand. But let's stick with the kind of the trend premise is that, listen, if we buy any time during an uptrend, the chances of us making money are higher than if we buy any other time. That's pretty much a given. If we long enough time frame, if we buy a strong market, unless of course we're at the top of the market, which the nature of a trend says that's only going to be a very small time period. Generally speaking, if we're buying in an uptrend, the trend is going to push our trade in the right direction, even if we kind of time it wrong. And this is where the whole trend trading thesis comes from. The whole quotes like trade with the trend, trend is your friend, except the bend at the end, and all that kind of stuff. It's just from history. If we're in a bear market, trying to pick the bottom is a much harder game than kind of sticking with the short side, and vice versa. If you're bull market, you're trying to short all the time in a bull market, you may have 5, 6, 7, 8, 9, 10 years of pain before you get it eventually right. So trading with the trend, and also from an intraday basis, if we're in a strong trend intraday, I've done videos on this before talking about trading with the trend and how to catch intraday trends. But if you're trying to fight that, you may well know, you may have had experience in this. I know I have years ago trying to fight intraday trends. It's just a losing battle. Eventually they'll turn, or they may turn, or they might close at highs, But the point is, if you align yourself with the trend, you're going to give yourself that little bit more of a trading edge than doing 50-50. Okay, number 4. Candlestick patterns. Again, we've talked about these in more detail, so I'm not going to go really down into it, but traders will look at candlestick patterns. We talk about things like, the shooting stars, the hammers, the hanging mans, bullish engulfing, bearish engulfing, all those kind of things, where literally you have a cluster of candles or one candle, and the position of those candles relative to the previous price action is going to give us a little bit more of an edge, a little bit more of an idea that the price is going to reverse or it's going to continue or whatever it's going to do. So this is another thing that traders are looking at, is candlestick patterns. So another thing that we can define as a trading edge. Number 5. Historic evidence and seasonal patterns. So what I mean by that, there's studies done that show that commodities come in cycles, and there are certain times of the year where, over the last 10 years or something, that particular commodity has risen, whether that's for a harvest, whether that's for weather, whether that's for farmers' decision, whatever it may be. There's historical evidence to kind of have this seasonal patterns to commodities. We also have it sometimes with equities. Selling may go away, the Santa rally, these kind of things come from statistical evidence that says that these things repeat. Whether they're going to repeat this year and next year, next week, you don't know that, but the theory being, if you'd have repeated that process over the past however many 10-20 years, you'd be good. And also, just very quickly, guys, from a day trading perspective, I know if I'm day trading something, I may well have looked at patterns that have occurred for the past 2 weeks in the market that I'm trading and said, hey, you know what, 11 o'clock every morning we have a buying algo come in. And that's just purely my looking and viewing and saying, well, if I find we're at support, when a buying algo comes in, I'm going to have a go at it. So historical evidence, whether that's your own evidence, your own back testing, or seasonal patterns, that kind of thing, you get the idea. Number 6, the trader's ability to read price action or tape reading. It's just kind of, again, if you've got an edge where you can read that market, the flow on the market depth, the tape, time and sales, look at the market depth, orders coming in and out, then that's going to give you a bit more of a trading edge. Number 7, probability of touch. What I mean by that, I basically mean that, a lot of traders will look at something like, okay, what's the most frequent or mode range we've had in this market? Okay, let's say, for example, it's been 100 ticks. If we're now up 90 ticks, would I buy it? Probably not, because the chances of us going to my 30 tick target are slim, because 100 ticks has been the most frequent occurred kind of range for the past month or whatever it may be. That kind of thing. What are the chances of it doing what you want to do? And then framing that into a trade and wrapping that up into a kind of trade. And the same for if we're day trading as well. First 15 minutes, let's say we had a 50 tick target and it's already done a kind of 30 ticks. We're probably not going to get it in the first 15 minutes without some sort of unwinding. So it's understanding the probability of the market you're trading touching the level that you're looking for, as opposed to just kind of hoping and say, well, I think it's going to go up 500 pips today, or points, pips, whatever you want to talk, ticks. And understanding, generally speaking, the market will stay within its kind of standard deviations. We're going to get exceptions. What we're talking about, again, with this trading edge is a frequency of occurrence. And number 8, the sentiment is skewed in one direction. I even like to flip this on its head, and we've touched on this before. When everyone is bearish on something, I'm definitely looking for the bullish side. I'm looking to see, where these guys are going to be wrong. We had an example. We have examples all the time of kind of real bearish sentiment, and it just changes in an instant, and it's caught a lot of people. A good example of that is kind of when you look at the short float on a specific stock, and it goes up and up and up and up and up, and there's a lot of people stuck short, and you can see it coming through on the short register. They're stuck, sentiment skewed in one direction, they get hammered. So there's potentially a trading edge there if we're fading in the extreme nature of the crowd. And the final one I've got for you, number 9, is a reprice scenario. And what I mean by a reprice scenario is something that comes out, some news that comes out as a binary event, i.e. news, economic data release, company earnings, that reprices or revalues that asset. So if a company comes out and all of a sudden says, you know what, we're expecting to make 13 cents a share, and now we've come out and we've made 6 cents a share. All of a sudden, the valuation of that company, all things being equal, is far less. It's a reprice scenario. People are looking at that and saying, hey, you know what? The valuation of this company now, if we assume that this is their new kind of earnings, it's nowhere near as valuable as it was before, and vice versa. And we have things like supply demand with oil inventories, not so much anymore. We kind of used to have a lot more movement on that. We have, you know, interest rate announcements. When we have a surprise interest rate announcement that raises rates, obviously that currency becomes more valuable. Or if we have economic data that suggests that perhaps the economy of the country is slowing, then that may well affect the reprice scenario, may reprice the index, it may reprice the currency. You get the idea. Anything that's a binary event that comes out and reprices it may give us a trading edge. Okay, so I've run through 9 very, very quickly here. There are more, obviously, but these things, just to cement the fact, are if we isolated these on their own, these are going to give us, arguably, a trading edge that gives us more than a 50-50 chance of success. If we look at chart patterns, we're going to get a good chance of success. Support, resistance, the list goes on. So in the next video, guys, I'm going to run through how we combine these and look to take advantage of these each individual trading edges. See you in the next one. Take care. Bye-bye.